The $500,000 retirement is not the problem. The person spending it down to zero while their neighbor, same amount, same market, same social security check, ends up at $2.1 million. That's the problem. And the gap between those two people isn't talent. It isn't luck. It's one decision about which kind of container they used to hold their money. I'm going to show you the container, and then I'm going to show you exactly why your financial advisor has a structural incentive to never show it to you himself. Here's what I think is genuinely broken about retirement math in America right now. We've been handed a model designed in the 70s, stress-tested in the 90s, and sold to us ever since. And it's optimized for exactly one thing: making you not run out. That's the entire ambition of the system. The 4% rule isn't about building wealth, it's about controlled dying of your portfolio. Slowly, so hopefully you die first. Preserve capital, withdraw 4% annually, hope the sequence of returns cooperates, and your kids get the furniture. That's the plan. That's what 3 decades of financial advertising has been selling as responsible retirement. But here's what nobody draws on the whiteboard. A specific class of retiree, not richer, not smarter, not luckier by any measurable variable, exits retirement with the same starting point and 30 years later has more money than they retired with. They spent freely. They took the trips. They helped the grandkids with down payments. And they ended with more than double what they started with. There is a formula behind that outcome. Not luck, not inheritance. A structure. I'm going to walk through it today, step by step. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. It uses BlackRock and Vanguard logic to expose the weak points in your plan, and I only ask for your email to send the report, so I don't store any of your financial data. Link in the description. Now, before we get into the mechanics, I need to give you one image, because I'm going to use it for the rest of this video, and I need it anchored in your head before the math starts making sense. There are 2 ways to hold water. You can hold it in a tank, sealed, pressurized, finite. Every cup you pour depletes it. You can manage the depletion carefully, stretch it out, drink slowly, but the end point is fixed. One day the tank is empty. Or you can hold water in a well, connected underground to an aquifer. You draw from the surface, the underground system replenishes from below, and as long as you're not drawing faster than it refills, you never run out. In a good season, the water level actually rises. Most retirees are living off a tank. The formula I'm about to show you is how you build a well. Every time I say tank today, I mean the standard retirement drawdown model. Every time I say well, I mean the structure we're actually building. The tank is engineered to run dry. The well is engineered to outlive you. Keep that. Now, I want to plant a flag here before we go any further, because this next part is going to change how you read your brokerage statement. In a few minutes, I'm going to show you exactly how something called sequence of returns risk destroys a tank, while a well weathers it completely. But first, here's why the tank is even more broken than you already think it is. John Bogle, the man who invented index funds, who spent his entire career fighting for the individual investor, calculated that over a lifetime of investing, fees quietly consume roughly 60% of a portfolio's potential value. Not the market, not your choices, fees. A 1% annual advisory fee on $200,000 compounded over 30 years costs you approximately $170,000 in lost growth. That's not a rounding error. That's a college fund. Gone. Not because you made a bad call, because someone charged you a percentage of your own money to hold it for you. The financial advisory industry manages about $30 trillion in retirement assets in America right now. And a lot of those advisors are genuinely good people. But their business model runs on assets under management, which means they're paid more to keep your money with them in products they understand and can explain than they are to help you build something self-sufficient. A well doesn't need an advisor to function. A tank requires one. That's not a conspiracy, that's an incentive structure. And once you see it, you can't unsee it. Here's the first mechanic: sequence of returns risk. This is where most tanks crack, and almost nobody explains it clearly. Imagine two retirees. We'll call them Phil and Richard. Same age, both 65. Both retire with exactly $500,000 in a standard stock portfolio. Both withdraw $20,000 a year. Same withdrawal rate, same portfolio composition. Phil retires in a bull market. His first 5 years, the market returns 12, 10, 11, 9, 13%. He's drawing down, but the portfolio is climbing. He's comfortable. Richard retires in a bear market. Same 5-year window, except his sequence runs -15, -20, +12, +14, +16%. Same average return across the decade as Phil. Mathematically, they should converge to the same outcome. They don't. Richard ends year 5 with roughly $280,000. Phil ends with over $530,000. Same average return, same withdrawal rate. A 47% difference in outcome, purely from timing. Richard isn't dumber. The market didn't hate Richard personally. The sequence hit him while he was drawing from a declining base, and early losses on a depleting balance never recover the way early losses on an untouched balance do. When you puncture a pressurized tank while it's half full, the pressure never fully rebuilds. You're always recovering from a smaller starting point. Here's what Phil and Richard have in common. Neither one had a well. Now, here's where it gets really interesting. Let me show you what the well actually looks like with real numbers. Take the same $500,000. Instead of one tank, you build 3 chambers. This isn't new. Financial planners call it a bucket strategy. What they rarely show you is what the math looks like compounded across 25 years of actual retirement. The difference is staggering, and I'm going to prove it. Chamber 1. $100,000 in cash and short-duration treasuries. At $20,000 a year, this covers 5 full years of living expenses. You do not touch the market for living costs. Not once. This is the draw pipe. This is the part of the well you drink from. Chamber 2. $150,000 in dividend-paying stocks, REITs, and income-producing assets generating roughly 4 to 5% annually. Call it $6,000 to $7,500 per year. That income either supplements Chamber 1 during volatile years or gets reinvested into Chamber 3 when conditions are favorable. This is the pump. Chamber 3, $250,000 in broad market index funds. You do not touch this for at least 10 years. This is the aquifer. Now, run Richard through this system. Same bear market opening, same bad sequence. Year 1, the market drops 15%. Chamber 3 loses $37,500 on paper. Richard is living off Chamber 1. He draws his $20,000 from cash. He sells 0 shares in Chamber 3. He actually uses some dividend income from Chamber 2 to buy more into Chamber 3 while prices are depressed. Year 2, minus 20%. Chamber 3 is down further on paper. Richard does not care. He has roughly 3 more years of cash in Chamber 1. He keeps buying into the dip. Years 3 through 5, the recovery comes. 12, 14, 16%. Chamber 3, which now holds more shares than it started with because Richard fed it during the correction, accelerates. By year 5, Chamber 3 has grown to approximately $340,000 despite the rough opening. Chamber 1 is now empty. Richard needs to refill it. He sells $100,000 from Chamber 3. He now has 5 more years of cash, and Chamber 3 still holds roughly $240,000, nearly what it started with. Plus, Chamber 2 has been running the entire time, generating approximately $35,000 of compounding income over those 5 years. Year 10. Richard has spent $200,000 in total living expenses. His total portfolio across all three chambers is approximately $680,000. He started with $500,000. He spent $200,000. He has more than he started with. By the way, if you're watching this and you're nodding along thinking this is exactly the kind of content you've been looking for, hit subscribe. Otherwise, YouTube's algorithm treats my channel like it doesn't exist, and genuinely may never show you another video. I've been told this is a weak pitch. I don't care. It's accurate. Year 20. Richard has spent $400,000 in total withdrawals. The portfolio is sitting at roughly $1.1 million. Year 25. 25 years retired, approximately $500,000 spent in total. The portfolio crosses 1.7 million. And if Chamber 3 keeps compounding at 8% through year 30, he's at 2.1 million. He spent basically his entire starting amount. He ended with 4 times it. That's not the 4% rule. That's not luck. That's the well. Now, I need to introduce you to two people. I've been watching this situation develop for about 18 months, and it threads through everything I'm about to tell you. So keep it in the back of your mind. There's a retired couple. I'll call them the Marshalls. Dave Marshall retired at 63 with $520,000 in a standard managed portfolio, 60% bonds, 40% stocks. The classic conservative retiree allocation. His advisor, genuinely well-meaning, told him, "Dave, you can't afford much risk anymore. Protect the principal." Dave trusted him. He built a tank. A very well-maintained, professionally managed tank. His brother-in-law Keith, same age, retired a year later with $480,000, spent 3 months restructuring on his own after reading about bucket strategies. His advisor thought he was making a mistake, too aggressive for his age. Keith built a well anyway. I'm going to come back to Dave and Keith at the end of this video, because 18 months in, something happened that made the difference between these two men impossible to ignore. Back to the formula. Here's something that no one in the 4% rule camp will say out loud, and it might be the most psychologically important thing in this entire video. You think the problem with retirement is math. Running the numbers wrong, saving too little, timing the market badly. That's the surface problem. The actual problem is identity. Most people approaching retirement have spent 40 years in one psychological mode: earner. Every financial decision they made was upstream of income. You earn, you save a percentage, you invest the rest, repeat. The earning is the engine. The portfolio is the accumulation. Income flows in, and you manage the overflow. Then retirement happens, and someone turns off the engine. What nobody prepares you for. When you stop earning, the psychological relationship with money flips completely. You go from someone filling a tank to someone emptying it. That transition, from accumulation mode to depletion mode, is where most retirements fall apart. Not because of bad investments, because of scarcity panic. A farmer doesn't look at a field of corn and think, "I need to eat this as slowly as possible so it lasts." He harvests what he needs, replants the rest, and next year the field is larger. That's the psychological operating system of a well builder. The portfolio isn't something you're slowly consuming, it's something you're managing. And here's the behavioral consequence. When the market drops, and it will drop, probably multiple times in your retirement, the tank drainer watches their net worth shrink with every withdrawal and starts cutting spending. They panic. The well builder looks at the market bottom. They guarantee their own worst outcome through completely rational feeling fear responses. The well builder looks at the same headline and asks one question: which chamber does this actually affect right now? The answer is Chamber 3, which they're not touching for a decade. So they do nothing, or they buy more. Either way, the draw pipe is unaffected. Vanguard published research they called Advisors Alpha, and one of the largest documented sources of value in professional financial guidance wasn't portfolio construction or tax optimization. It was behavioral coaching, preventing clients from panic selling during corrections. That single intervention, stopping people from doing the obvious thing at the worst moment, added an estimated 3% annually to long-term returns. 3%? per year, compounded over a 30-year retirement. On $500,000, that 3% behavioral edge compounds into approximately $1.2 million in additional wealth over 30 years. Not from better stock picks, from not panicking. The well doesn't produce more water, it makes you calmer at the pump. Now, here's where most people stop optimizing, and it costs them roughly $250,000. Housing. Hear me out, because this one is uncomfortable, and most financial channels won't touch it. By 65, the average American homeowner carries roughly $300,000 to $500,000 in home equity. The house is paid off, or nearly. And conventional wisdom says, stay. It's yours. It's home. It's familiar. It's where the grandkids come for Christmas. Let's actually run the numbers on what that house costs you in retirement. Property taxes, insurance, maintenance. The average homeowner spends about 1.5% of home value annually on repairs alone. Utilities. On a $350,000 house, that's roughly $15,000 to $22,000 per year just to maintain the privilege of owning it. And the equity sitting in those walls is growing at maybe 3 to 4% annually. Real estate nationally has averaged about 3.8% appreciation since 1990, roughly in line with inflation. Your equity, best case, is keeping pace with inflation while it costs you $20,000 a year to maintain. Compare that to taking $300,000 of that equity and placing it in chamber 3 of a well. At 8%, $300,000 becomes $648,000 in 10 years. It's liquid. It generates no property tax. It requires no maintenance call. I'm not saying sell the house. I'm saying do the math you've probably never done on what holding the house is actually costing you. Most people know what the house cost them to buy. Almost none of them know what it costs them to keep, in retirement terms. You know what's actually funny? There's an entire industry of advisors who will spend 45 minutes explaining why you need to rebalance your bond duration quarterly. 0 of them will look you in the eye and say, your house is costing you $1 million over 30 years. Because one conversation generates a management fee, and the other one generates a client who starts asking uncomfortable questions about why they're paying you at all. Let me make this concrete. One real scenario, real numbers. Sandra is 64. She has $500,000 in a 401k and a paid-off house worth $310,000 in a moderate-cost suburb. Her advisor builds her a classic conservative portfolio, 60% bonds, 40% stocks. She withdraws $22,000 a year and collects $18,000 in Social Security. Total income? $40,000 annually. Fine. Workable. 25 years later, Sandra is 89. The portfolio is largely depleted. The house appreciated to around $450,000, but it's illiquid. She can't spend it, and the maintenance has eaten into her cash reserves for years. Her liquid assets are under $100,000. She's technically okay, but the margin is thin, and stress is permanent. Now run the alternative. Sanders sells the house at 64, nets $310,000 after costs, rents a clean 2-bedroom in a lower tax state for $1,800 a month. She misses the neighborhood for about a year. Her new investable portfolio, $810,000. She builds the well, $160,000 in chamber 1, $240,000 in chamber 2, $410,000 in chamber 3. Dividends from chamber 2 cover most of her rent. Chamber 3 grows untouched for a decade. 25 years later, at 89, Sandra's portfolio is worth approximately $2.4 million. She spent roughly the same on living expenses. She freed the trapped equity and let the aquifer do what aquifers do. Same woman, same discipline, different container. Completely different ending. Now, I promised you I'd come back to Dave and Keith. 18 months into retirement, Dave Marshall, the one with the conservative managed portfolio, 60% bonds, hit a problem. His original advisor retired. The new advisor at the firm suggested some restructuring for efficiency. Dave agreed. Nothing dramatic, but the sequence of small allocation changes layered over the mild correction in early 2025 left Dave's portfolio down about 14% from his retirement starting point. He's drawing from a tank that just got smaller, and he's nervous. He cut back on discretionary spending. He canceled a trip to see his daughter. Keith, the one everyone said was too aggressive, is sitting in Chamber 1. He watches Chamber 3 correct on paper and does nothing. He hasn't touched Chamber 3. He doesn't need it for another 9 years. He is calm in a way Dave is not. And that calm is not a personality trait. It is structural. The well doesn't panic. You can't panic sell an aquifer. Dave has a very expensive, professionally managed tank. Keith is fishing. Here's what I want you to walk away with. 3 things. Not generic, calibrated to this specific formula. First, separate your spending from your growth before you retire, not after. You need to know right now, not when you're 65 and watching your balance drop, exactly how many years of living expenses you can park in cash and short-duration instruments without touching equity. If you cannot cover at least 3 years of expenses without selling a single share, your well is not built yet. The sequence of returns risk I showed you hits hardest in the first 5 years. That is when you are most exposed. Plug that hole before you hand in the badge. Second, run your combined drag number. Add together what you're paying in advisory fees, fund expense ratios, and annual housing costs, taxes, maintenance, insurance. That combined number, projected forward 30 years with realistic compounding, is what your current financial structure is actually costing you. Most people who do this calculation for the first time sit with it quietly for a while. That silence is the sound of a tank draining. Third, do not treat the first 5 years of retirement as a reward for 40 years of work. Treat them as the most critical compounding window of your financial life. The money you do not touch in years 1 through 5 is the seed of everything you have at 85. At 8% over 25 years, every $50,000 you spend in year 1 costs you approximately $340,000 in future value. Take the trip, but know the price. Look at it directly, and then decide. That's not deprivation. That's the difference between a conscious choice and an expensive impulse. Lazy investing built more fortune than crypto memes, and the laziest investment strategy in the world. Building a container that works while you sleep, while you travel, while you do nothing at all, beats every frantic reshuffling, every tactical reallocation, every advisor-recommended restructuring that tank owners pay for in fees and anxiety and canceled trips to see their daughters. The water level in Keith's well rose again this quarter. Dave's tank is at 61%. Pick your container